This morning, we begin with an update from the global economic stage. The IMF, the International Monetary Fund, cut Nigeria's growth forecast for 2025, dialing it back to 3.0%. That's down from the earlier 3.4% projected for 2025. The reasons, they say sluggish oil supplies and rising tension in global trade. Welcome to Economy and Market on BusinessDay TV, where we give you a comprehensive breakdown of market and economic activities. I'm your host, David Olujimi. According to the IMF, Nigeria's economic outlook has dimmed a little further. The IMF, at the ongoing spring meetings in Washington, trimmed our growth forecast down from 3.4% at the start of the year. It's now at 3.0. Nigeria is not the only country affected by the growth forecast. We have the same for the US, for India, for China, and all the other, and sub-Saharan Africa as a whole, including the global economy. According to the IMF's World Economic Outlook, Nigeria, alongside other commodity-dependent economies, are working on a fiscal tightrope. Oil supply is weakening based on the fact that demand from major importers is slowing, and this is all tied to the global trade tension that we can say is tightening the noose. Let's break this down. IMF says oil exporters like Nigeria are in for a tough ride. Revenues are falling, and so is our fiscal space. That means there's less money. There's probably going to be less money this year to fund capital projects or pay down debt. And this pressure is made worse by market volatility. We've seen trillions of dollars wiped off global equities market in recent times, and there's also like a shift in global asset valuation. Globally, trade is now a battleground, with US and China slapping tariffs up and down. The IMF has warned that we are entering a new era. They say it's an era where the rules of global commerce, which have been in place since World War II for more than 80 years, are being torn up and rewritten. During the spring meetings that has been holding this week, the chief economist of the IMF, Olivier, said effective tariff rates are now at levels not seen in a century. What does this mean for Nigeria? Basically, I think we're seeing the symptoms. We've seen inflation rates go up quite a bit for March. Then we are seeing slowing growth. We are going to be expecting to see slowing growth. Our equities market is not ticking as we expected it to tick. There's been limited fiscal room basically, and all of this is happening while Nigeria is just reeling. We're just coming to a point where we want to balance out from all of the subsidy reforms, FX instability, and record high inflation. All of this is, we are now at the point where, as we are coming out of one thing, we are entering into another thing. And the bigger picture may even be more concerning if you zoom out to sub-Saharan Africa. So in sub-Saharan Africa, IMF shows a picture of a continent of two different categories of countries. One set of countries, they are racing ahead, IMF says, with innovation and reforms. They are smaller economies per se. Then we also have the larger resource-heavy countries like Nigeria, which are lagging behind. Nigeria, South Africa, and we have the same with Kenya, lagging behind. Before 2014, Nigeria was part of Africa's success story. But since the oil crash in 2014, we've been stuck. Our growth has slowed, incomes have stagnated, and our dependence on crude oil, coupled with some of our weak institutions, have turned every global shock in the world into a local crisis for Nigeria. On the show this morning, we have Dr. Oluwanbepelumi Olanubi, the co-founder and executive director of Kingsgate Advisors Institute. She's a seasoned economist with professional experience in macroeconomics, international economics, and development economics. Good morning, doctor.
Good morning, David. Thanks for having me today.
Yes, it's great to have you here. So we're just going to start right away. What are some of the takeaways from IMF's economic growth, some of the takeaways from their outlook for Nigeria and especially their inflation outlook? How have they compared with previous forecasts?
All right. Thank you once again. all week that has been the discourse given the IMF World Bank strengthening will happen in the shipping industry. And if you look at the report carefully, you will see or you notice that the downward revision was done for most of the economies in the world. And the reasons are not far-fetched. We are entering a season or a new world order where some would argue that this could be the end of globalization, while some would say globalization is coming with a new redefinition, a way of defining globalization as we've all known it is changing. And in fact, like I said, some would argue that this is actually the end of globalization. Having said that, if we zoom down to South Africa and also Nigeria, you will see the downward revision. And as you know, Nigeria is a small open market economy, and whatever happens in the global space has direct impact or heavy impact on our own economy. And given that, you also alluded to the fact that we just rolled out some reforms within the country in the last 2-3 years, we'll say 2.5 years, and we are just reading up the benefits or the impact of these reforms on the domestic economy. And now we are seeing external forces, particularly from the geopolitical side of things, if I'll put it that way. We've seen how the Trump administration has slammed tariff across all countries, and we are seeing this embrace of protectionism rather than liberalization, or what we call trade. And this is what we now term trade war, or what we call global trade tension. So this has direct impact on global commodity prices, of which crude oil is one of those commodity prices. And you know, for Nigeria, we are still heavily dependent, sadly so, that we are still heavily dependent on crude oil as our major source of foreign exchange. This definitely has a direct impact, first on the government's balance sheets in terms of revenue to the government, and also even through the exchange rate, part. We noticed in the last couple of weeks, we've seen the exchange rate, seeing some form of pressure on the exchange rate market, and we're seeing the exchange rate tending towards 1,600. All this together are part of the reasons why the IMF reviewed our growth projection, which was supposed to be, according to their first World Economic Outlook in January, was they projected it that the growth rate of Nigerian economy would be at the pace of like 3.2%, but they reviewed it downward by a decrease of 0.2%, and they are reviewing it and forecasting that growth rate in Nigeria would likely land us at 3.0% at the end of the year. Secondly, they also reviewed the inflation. Inflation also, they are expecting to see the impact of this, particularly crude oil price, through foreign exchange market, and even generally commodities markets, because we also depend heavily on some commodities, and this will also have impact on our exchange rate, and this will feed into domestic prices, feed into cost of production. And like I said, we still have our reforms, the impact of the reforms. We are still reading up the impact of the reforms, and all that coupled together would the forecast that we will see inflation also trend upward at an average of about 26% this year, and probably over 30% next year. And this is the reality, and this is where we find ourselves as a nation.
Oh, these are the word I use is damning realities in a way. But now I want to move to a question about the tariffs. So basically, IMF has projected that there will be a decline in global growth, and Nigeria is a commodity dependent economy, that we depend on the export of commodities to survive as a nation. That's the source of our government revenue. How do you think that the tariffs or the reduction in global trade is going to affect Nigeria's oil-dependent economy? What are some of your thoughts? Can you explain to our audience how this? Do you think there's any correlation, or how do you think it's going to play out?
Thank you. So sadly, we've been talking about diversifying the economy or the revenue base of the economy away from oil for decades now. There have been talks about this, and we have been seeing some reforms actually in this line, but we are not seeing the impact, and we are still largely depending on oil as a source of our external, as a source of our foreign exchange, as a major source of revenue to the government. And you know that oil market, the way the oil market is actually very volatile. Not even just because of the current geopolitical tensions and the tariffs from Trump and the impact on commodities market, but generally any small any oil market is very volatile and it's sensitive to even speculation. Anything can trigger the market. And once there is a trigger that way, it could lead to an upswing or even downswing. But for the oil market, you will see that the oil price is already trading below our current benchmark of $75 per barrel. Now the oil price is hovering around that $65 per barrel, and that's like $10 short, and that's huge. That's on one side. On the other side, if you look at the report recently, that about 92 million barrels of oil from Nigeria has been hanging, and there's issue with supply. So that also will feed into government revenue. And if you look at it also in the global space, you will see the demand for oil also is reducing. And if you see that this decline in global oil demand, particularly from China, can also incentivize OPEC to continue to cut their oil production quota, and that would also affect Nigeria. And let's look at how this directly affects us. Nigeria as a nation, we are more sensitive to oil production than oil price. Why? Because we are price takers. We are a small macroeconomy, and we are price takers. So whatever happens to the oil market, we take oil price, we take it the way it is. The only thing we can sort of control is the volume of production that we supply to the market. And sadly, so we're already seeing this decline, and that will definitely put more pressure on the government balance sheet and affect the government's earnings, sending the signal towards more borrowing, which we don't want to see actually.
Wow. Okay. But another question is now, okay, let's try and bring out the positives in all of what we see. We see it's not a very good look going forward, at least from the empirical state of things. When you want to empirically look at it, we are not in a very good state. But can Nigeria capitalize on shift in global supply chain to attract investment, or can we boost our non-oil exports? So we have China at 245 tariffs from the US, meaning that trade between US and China is almost effectively outlawed at this stage. Can Nigeria step into some of the global supply chains? Can we fill up the gaps? Can our shoemakers probably step in? Do we have what it takes to boost our non-oil exports?
This time is particularly important for us to look inwards. And when I say inwards, I mean Africa.
Okay.
It's time to boost our trade relationship within Africa continent, and we should leverage African Continental Free Trade Agreement. Recently, the government actually approved a 90% tariff waiver on some of our export into some of these African economies. And although AFCFTA have been around for a while, but we have not seen the impact so far because likely we are not taking advantage of this provision. So it's time for Africa to first negotiate with our current trading partners beyond the shores of Africa. Let's see negotiations that are favorable. And secondly, let's also deepen our trade policies even within Africa. That also will help us weather the storm. If we look at also some other countries within the African continent that we are not even trading with currently, but there's possibility of trading with all those African countries. So we need to actually look at region-based, ECOWAS, Sub-Saharan Africa, how we can trade within ourselves so that we can first reduce the impact of this global. And you know that tariffs from the United States impact almost all economies in the world. So every economy sort of are doing this precautionary policies. Everyone is taking this precautionary stand to still protect its fragile economy. So in the sense of that, conversations and negotiations are necessary, not just with our current trading partners, but let's look at inwards, looking at Africa. In addition to that, also within the economy, we need to have a well mapped out and a well written industrialization policies that will help our domestic firms. In addition to that, also we need to strengthen the current trade policies. That would also help how we interact and how we transact and negotiate with other economies, particularly within Africa.
Okay. We've talked about this subject quite a number of times, especially when it comes to trade within Africa. Trade within Africa, we've seen, I think, is the golden geese right now that Nigeria needs to be looking at. You mentioned something about debt, something that we don't want. Debt servicing cost in Nigeria has been a problem since 2020. I think in 2020 it was at 97%. Now we are down to 68%. That's debt servicing portion of the revenue, like debt service to revenue ratio, is around 68%. Basically, it's straining revenues, and we are getting to a point where I would say revenue from the regular sources may not be as consistent anymore. What practical steps do you think? It means that this year we are going to probably see Nigeria borrow more than we have done in the last 2 years. What practical steps do you think Nigeria can take to avoid a full-blown debt crisis right now? Is there any way out of it?
In my own opinion, our options are very few. This is a time for us to actually embark on fiscal consolidation. I know a lot of talks have been around and have been efforts by the government also, but I think we need to intensify effort towards that. And how do I mean? First off, the tax reform that we've seen embarked on by the tax reform committee chaired by Mr. Taiwo Oyedele. So we've seen them, I think they've made a lot of progress with that reform. At this point now, what I think is just to sign it into law and start implementation. So they've made a lot of progress, and I understand that this tax reform will also first of widen the tax gap, widen the tax base rather, and in place of doing that, yes, widen the tax base, and also in place of doing that, as a way of protecting small companies or small firms that are still struggling, so there's a way of protection to smaller, but also sort of taxing the bigger company, which would also help in terms of revenue mobilization for the government. That's one. Secondly, we also need to see more efficiency in government spending. We need to see more efficiency. And the first thing I would even highlight on that is to see a reduction in cost of governance. I don't want to go so much in depth in that, but we really need to do this governance shrinking and trimming all those leakages and all those excessive monies that are going on unproductive economic activities. The third point, I think one of the ways we can free up some liquidity for the government is also to sell some of the assets that are idle. Some assets are tying down a lot of capital and they are idle. So governments can either privatize this asset or involve in PPP, public-private partnership, or even concession of some of these assets that will free up some liquidity that the government can use. And if we have to borrow, we should go towards more of concessional loans that are long-term and with little or a small interest rate, because we are in high interest rate environment. If you look at the yield and the spread, we're still in high. And the debt burden is still very high. So I would recommend that we just keep on borrowing, because of debt sustainability and debt crisis, So we can actually do this fiscal consolidation strategies and see how that can help with mobilization of funds within the government and the Nigerian economy at large.
So one last question. The last question is about tariffs and how they affect Nigeria's reliance on imported goods. Basically, we import. So one of the days I was discussing with a colleague, and he said cars are about to get more expensive. I thought about it. Why? We don't import new cars into Nigeria. Basically, Nigeria is not a hub for new cars, and he talked about the fact that the old cars that are used in Nigeria will come from the places where tariffs have been set in place. So basically, how do you think Nigeria's reliance on imported goods, the whole tariff war, how do you think is going to affect or is going to worsen our inflation, and what domestic alternatives can we prioritize right now?
Like I rightly said, to say it frankly, our options are actually very few. The fiscal space is very fragile and is very small in that sense, if I use that word, and that also would affect how much capital infrastructure the government can embark on to support businesses and local production. But we are heavily reliant on imported commodities, starting from, like you said, automobiles, even to pharmaceutical, just name it, even global commodities, that we use in our value and that we use in our production. So first off, we need to actually look inwards and have more import substitution strategies. Why this is sort of long-term or medium to long-term in nature. It's a way of still building buffers eventually against what would happen. But in the short term, we can look at African continent, how much we can import within the African continent just to minimize the impact of these tariffs and how it will affect our imported commodities, knowing fully well that we're already in a high inflationary environment and imported inflation is already eating up, aside the fact that we have the exchange rate issue, exchange rate stabilization issue, we still have some inherent issues that are still driving inflation. If you look at inflation numbers, month-on-month inflation, you see that upwards trend. And if we are now adding this volatility from the global space into the equation, it just signals that things might get worse. So one of the ways we can actually cope that is to leverage, like I said, African Continental Free Trade Agreement first, and also see a way of incentivizing some of our local producers. The government should also create an enabling environment for businesses, for investors. That is also important. Then lastly, which I mentioned before, we still need a clear-cut industrialization policies. This would also help investment to come in. It will help small businesses and will even help the economic, to go on the path that we on the path and the trajectory we have set for ourselves. So these are the few things we can do. Like I said, our options are actually few, but we need to look inwards and also see if we can trade within the region.
So thank you so very much, Dr. Oluwanbepelumi. Thank you so much for your time. It's been insightful listening to you. Thank you very much.
Thank you. Thank you for having me. It's my pleasure.
Yeah. Thank you to our viewers. Thank you for tuning into Economy and Market on BusinessDay Television. It's been great having you here. We see you again on Wednesday next week. Have a wonderful weekend.